Hi, I'm Don Spillane, President of Designing Financial Solutions, introducing the essentials of business planning. And today we're going to be talking about business succession planning, triggering events, and funding the buy-sell agreement. And a triggering event includes death, sickness or disability, retirement, termination, insolvency, divorce, agreement violation, or loss of qualification to own equity, and that may be the loss of license to practice law or real estate, for example. So when any one of these triggering events occur, the appropriate interest in the business is purchased by remaining owners, family members, or key persons, whoever is designated in the succession agreement. So you've had a triggering event. Now you're looking for a way to fund the buyout of the co-owner. Many companies rely on the company's surplus or asset liquidity. Unfortunately, there's no guarantee the funds will be available when needed. Large amounts of surplus cash are usually already in use. And the problem is compounded when a co-owner departs prematurely. Another way of funding the buyout of a co-owner is the sinking fund, essentially a savings account. And some business owners try to accumulate a sinking fund to provide the lump sum needed to complete the buyout. Unfortunately, timing is a major hurdle, and that's compounded by a premature departure of a co-owner. Then it relies on the company's self-enforcement, and owners cannot be certain of complete funding when it's actually needed. Then there's the installment agreement. This is where the parties agree to pay the purchase price in installments. Payments are spread over a number of years. It's favorable if it's a planned tax savings vehicle with maybe a large down payment, interest payments on the balance. There's a definite default risk. Family must rely on the obligated party to remain in good health and financial standing, and it doesn't work if the heirs need all cash. And then there's borrowing. Unfortunately, the ability to borrow may be uncertain. You may not qualify for the loan. The costs of borrowing are unpredictable. Interest rates may be excessive. This tends to be the most expensive option. So to the rescue comes life and disability buyout insurance man. And the reasons are it's the most reliable with ascertainable costs. Cost recovery is involved, and generally it's the least expensive option. Guarantee of funds in the event of premature death, sickness or disability, and cash value gross tax deferred. And it supplements a lifetime buyout. It's easily the most popular way to fund a buy-sell agreement. There are some disadvantages to using life and disability buyout insurance as your funding vehicle. Premiums generally are not tax deductible as an expense because the benefits are received tax-free. Co-owners may not be insurable because of illness or age, and younger co-owners may pay higher premium on older co-owners, and the amount of insurance may not grow with the business value. You'll have to either increase the amount of insurance or define how the difference is going to be funded. Thank you for watching. Contact us for more information. We offer a free 1-hour consultation.